Have you ever heard the saying, if it were easy, everyone would be doing it? Investing is not simple for many reasons, especially when there is so much negative news at our fingertips, impacting our emotions. The stock market provides an average annual return of 10%, but to get that return, an investor needs to sit through the ups and downs, which can be large and extended. When markets are going up, we feel great, but when they are falling, we feel terrible and extrapolate that fear. That leads us to a common investment mistake, thinking that negative news means negative markets. It's a news editor's job to sensationalize headlines, so it's no surprise that they instill fear when the news is bad. But that doesn't mean the equity markets are also going to be bad. Looking back over scary headlines from multiple decades, we can see that the equity markets went on to have strong returns. Hearing the word recession may lead some to run for cover. But looking back at the last 6 recessions, we can see that equity markets were generally positive during a recession. That's because economic data is backward-looking and the stock market is forward and anticipating an economic recovery. Bear markets also create fear as the losses extend beyond minus 20%. However, moving out of the markets could be costly as the market tends to rebound strongly and quickly. Most of the 5-year average annualized return was achieved in the first year following a bear market. In fact, if an investor stays disciplined and invests in a bear market, those investors create the most value in an investor's portfolio. As we've seen, negative news doesn't always equate to negative markets. In fact, they can offer some great investment opportunities. We just need to remember to put on our noise-canceling headphones and stay focused on our investment goals. Thanks for watching.